Welcome back, investors, to Ticker Time News. I'm Adam. And the stock market, well, it had a rough showing today while it continued to deal with concerns that it may have gotten carried away with expectations of a Fed policy pivot happening anytime soon, and amid some hesitancy in front of the September employment report that's due out tomorrow morning. The S&P 500 has rallied nearly 7% this week since closing out September and Q3 at a fresh year-to-date low, but it's currently struggling to surpass its downsloping 20-day moving average, which is right around the 3,800 vicinity. Coincidentally, this also aligns around the 38% Fibonacci retracement level, which is at 3788 of the September high to low range. So sellers are willing to get back involved at this resistance zone, while the bigger picture trend still remains in their favor to do so. Now, on the flip side, buyers did clear last week's highs. That's a good thing with the major indices. So there is the potential for the downward momentum to change direction, at least for the first half of October. But clearly, there are some hesitations ahead of tomorrow's jobs data. Now, I want to point this out to you on the screen. Let me get my highlighter here. The 20-day moving average, it's acting like resistance. But let me show you this too. This trend line right here, this blue trend line that's coming down just like this, okay? That trend line right there, of course, grabbed this right here, that spot in the market where it hit it, found resistance, broke down. It also slightly popped above its 20-day moving average right there, and that's the last time it did that. And then here, it did break above. Oh, let me grab that highlighter again. And then right here, it did, for one day, break above that trend line, but it closed right on its 20-day moving average. And now you have right here, the past 3 sessions, it ran up to that 20-day moving average and that downsloping trend line right there, and it has found resistance. Every day this week, it has not been able to break above that trend line or the 20-day moving average. So there is some weakness here and some selling into strength. Good afternoon. How are you doing? Hope you're doing well. So there is some weakness right here at the 20-day moving average. Now, it is possible that this is just a digestion stage, right? The market has to digest the information it gets. It also has to digest the price action. And we had a major gap up right here, right above the upper end of the weekly expected move. Big gap up there. And now we're just kind of hanging out using the 20-day and this blue trend line right here as resistance, as the market kind of says, okay, what are we going to do with this? Are we going to take advantage of this, and are we going to move higher, maybe up to that 50-day moving average? Or are we just going to hang out here for the rest of the week? I mean, we are above the weekly expected move, which is right 68% of the time. Now, I know the volatility, it still remains elevated despite the VIX dipping back below the 30 mark on this relief rally that we've had so far. But it's really only been 2 days that this rally held it together. We're looking for a follow-through day. We haven't seen it yet. Sometimes it takes, after a big move like this, 3 or 4 days before we see that follow-through. So I'm seeing this right now, the price action, it's queuing up. It did reconnect with that 5-day EMA today, which is very important. So maybe we're just going to start to potentially flag a bit here or get caught in a triangle pattern. And then maybe we get some good news on the job front, and that breaks us out of that resistance area. That's a possibility. That's at least one of the probabilities for tomorrow. Other than that, if it's bad news tomorrow on the jobs front, this thing is going to come right back down into the weekly expected move. And I know the options market has been inefficient over the past several weeks, but mainly because volatility has been increasing. So there's our two probabilities tomorrow, and it all hinges on the jobs report. If the job numbers are decent, then we could break out of this resistance area, this trend line and 20-day moving average, and move higher. But if the jobs data isn't good tomorrow, then we could sink right back down into the weekly expected move. Now, the upper end of the weekly expected move is at 37.07, which is about 370 on the SPY. And we'll look at the SPY, and I'll call that out again to make sure that you have it. Now, when we have high day-to-day volatility, it continues to act in favor of technical or tactical. I guess I should use that word. Tactical trading. So small position sizes, taking it easy, being patient, right? Don't jump into something just because the market moves in one direction for half an hour, right? Take it very slow. Buying weakness in support zones and selling strength into resistance zones. That's the game plan right now. That's the technical, or what did I say I should use? Tactical. The tactical trading right now. That's the best thing that you can do. Tactical trading. Buying weakness in support zones and selling strength into resistance zones. That's the game plan right now. From a bigger strategic standpoint, the risk off approach remains dominant for most portfolios, along with deploying various hedging and diversification plans to reduce risk. The biggest name of the game right now is to reduce your risk. Take as little risk as possible because you don't know, because high volatility, things can go either way and rather quickly. Now, the major averages, they were influenced by the behavior of the treasury market today, just like they were yesterday. The 2-year yield, let's look at that right quick, and then I'll come back to the indices. And I'm also going to talk about the housing market. I got an image to share with you. All right, US 02Y will take you to the 2-year yield. It saw 4.14% earlier today. It traded above Friday's close, but it settled at 4.23%, and it's up just slightly in the after hours. So it too, right now, it's kind of just moving sideways. It had that ginormous run expansion, which leads to contraction, and right now it's contracting. It's staying put. What's going to happen next, right? It's a big question, but it was up 10 basis points on the day. Now, the 10-year yield, let's look at that, US 10Y, and there is a link in the description to TradingView. Click on it. It doesn't cost anything to sign up, and you can use the charting features for free. Here's the 10-year. It was on a march just like the 2-year. It stood at 3.74% overnight, but it also traded above its Friday's close, which is a bullish development. And it settled at 3.83%. That's where it sits right now. It was up 7 basis points on the day. Now, as Treasury yields moved higher, the major indices moved lower, and they struggled to mount any sort of comeback effort today. They ultimately finished near their worst levels of the session. Here's another pressure that was on equities today, the US dollar. Let's pull that up. DXY is the ticker. You can call it the Dixie DXY, help you to remember it. But the US dollar was up 1% today. It closed at 112.18, acting, like I said, as an additional headwind for the equity market. Now, the dollar, it has cooled off significantly, right? But it is still not at a point where I could firmly say or comfortably say that the dollar's reign is over. Look up the dollar milkshake theory if you haven't already. I've mentioned that a few months ago when the dollar was just ripping it. Read that. Dollar milkshake theory. Read it. It's very interesting, and I promise it's a good read. The dollar milkshake theory basically says that the US dollar is going to continue to be strong, sucking up other currencies along the way. And then we have real problems. So the dollar milkshake theory, it does not say that things are going to look bright and beautiful and, the market's going to go up. No. It is something you do not want to see happen. It'll wreck the markets globally too. But look into that. Again, dollar milkshake theory. So the dollar, again, it's strong. It's still making higher lows and higher highs. As long as it continues to do that, then it's going to move up. And a strong dollar, it is hurting the price of gold. So if you ever wanted to actually buy physical gold, right now is one of the better times to do it. If you wanted to trade physical gold, it's not really that great right now for trading. But buying the actual physical thing, with the dollar being strong, that's keeping gold prices down. Eventually, the dollar will lose its strength and it will come back down. And when that happens, that's when gold will finally catch a bid and start moving higher. So we've got that. And secondly, with a strong dollar, we're going to continue to have a weak equity market. And right now, like I said, it's making higher lows. So it's still got strength. It is above its 50-day moving average, and it has been above its 50-day moving average going back to February of this year. And if we go back further, there was a little bump in February due to the war in Ukraine kicking off. That's what kind of brought it down below it, but it pushed right back above it, and it had been flying above it for a while. So for this thing to start losing strength, I would need to see this thing come back down to 109, 108, maybe even as low as 106. Then I would say, yep, now it's making lower lows, so it's losing some of that strength. But as it stands, it's not right now. All right, another thing that hurt markets, and I'll go ahead and pull the SPY up here so we can talk about that, was hawkish Fed speak. I mentioned it yesterday as what to look out for today. Man, oh man, and was it hawkish? So, Fed speak, we had two that were pretty substantial. The Atlanta Fed president, who is a 2024 FOMC voter, so they are not a voting member right now. They are not a voting member next year. They will not be a voting FOMC member until 2024. But Atlanta Fed president said inflation, or the inflation fight, is still in its early days. And the Minneapolis, oh my goodness, getting tongue twisted here. Minneapolis Fed president, who's a 2023 FOMC voter, said that he is not comfortable pausing. And when they say pausing, they mean rate hikes until there is sufficient evidence of inflation cooling. Wow. What is that? What's sufficient evidence of inflation cooling? Are you talking CPI report, core CPI, PCE? I mean, what are you talking about here? Right? Man, and for it to come down and start cooling off, I would have to say below 5%. And we're not near that. We're still above 8%. And if you look at real CPI numbers and real inflation, not the cook the book CPI numbers, we're in double digits still. So, and that's going back to the 80s. You can also research that. It's pretty interesting. Now, in addition, there was heightened geopolitical, I always get that word mixed up, uncertainty after OPEC Plus agreed to cut production by 2 million barrels per day starting in November. We talked about this yesterday. Now, a move that drew sharp criticism, this 2 million barrel production cut starting in November, it drew sharp criticism from the White House. but the Saudi officials and Russia seem to be lockstep in this, in raising the price of oil. Okay, let's go to U.S. oil on TradingView. Let's look at this. The Saudis, the Russians, they want the price of oil to go up. Just think, over the past 2 years, there hasn't been a whole lot of profits in oil, right? Just think about this for just a moment. I might be getting a little blank crazy right now, but just think about this for a moment and see how this stands with you. What do you think was said at the OPEC Plus meeting yesterday? I'm going to open this chart up here so we can get a bird's eye view. I want to go back to 2020 on the chart for the price of oil. There it is. There's the big dip in the price of oil. So going back to 2020, okay, that big drop that's right here, all right, this like V-shaped drop right here. This was in April of 2020. Let's go back a little bit further. That was a big drop. Just a little bit further. I want to get all of 2020 in here. There it is. It actually goes back to 2018. Okay, so the last V dip right here, this was in 2019. All right, January 2019, 2018 December timeframe. That was the bottom. So if we have this line here at $75 a barrel, which was about the peak right here, and then we start losing on oil trade, and then we reach this peak right here, okay? And that's about $65 a barrel. Then we have the big V-shaped bottom here in oil in April of 2020. Then from there, we rally and we rally hard. So yesterday at the meeting, OPEC Plus, they're thinking, well, back in 2018, 2019, we had a dip and we were making $75 a barrel. That's what the price was, right? But over the past 2 years, since the April 2020 dip, I mean, the dip right here, oil went negative, meaning you basically got oil free. It went negative. It didn't stay there long. It was a quick V-shaped recovery. But when it recovered in September of 2020, right here, it was only at about $40 to $43 a barrel. Then oil started to rise, right? We got this rally, real strong rally, staying on that 200-day moving average. That was until oil peaked. We had two peaks. We had this peak here in March of 22 this year, and then this peak right here, which was June of 22. But since the June peak, it has been falling, and it got to a low in September around $75, $74 a barrel. So let's think about this. We've seen the path of oil over the past couple of years. The Saudis and the Russians got together and said, you know what? The profits that we were making in March, April, May, June of this year were pretty darn sweet. Let's all get together and let's push oil higher because those profits were way too sweet. We need them. We want them. So they're going to cut production to raise the price of oil. Raise the price of oil. It rose 1% today. I didn't think oil would go up today. I really didn't. I thought oil, it had gotten pretty hot over the past few sessions. So I thought today would be a cool-off day. No, I was wrong. It was up 1% to $88.51 a barrel. So OPEC Plus seems to be saying, well, you know what? Oil got cheap we didn't make a lot of money. But now I think it's time that we get our dues, and we're going to cause the price of oil to stay high. We're going to cut production to manipulate that price to make sure that it stays high, so those profits continue to keep rolling in. All right, there's my tinfoil hat. Take it off now, and we can move on. But what do you think? Could it be realistic to think that? Is that the play in hand right now? I mean, it seems like it. All right. Oil did get back into this green bar here today. And I want to point this out. Let me open it up a little bit here. Yesterday, it closed above its 50-day moving average. My apologies. Today. Yesterday, that was resistance. It got disconnected from its 5-day EMA. That's the two reasons why I thought it would pull back today and we'd have a red day. But no, I was wrong. It went above its 50-day moving average, which is a bullish development for the price of oil. And it closed within that green box again, which has been an area of support for oil. So it's disconnected from its 5-day EMA. It did not reconnect today. I can't imagine it keeps going. However, when the price is being manipulated by cutting the production of oil, then who's to think oil is going to come down? I don't know. I just had that thought today and it didn't sit well with me. I know it's a tin hat type of thought, but I just wanted to put it out there. See what you think, whether you agree or not. Would that increase the price of goods? Yes. When oil goes up, the price of everything goes up because oil is what is used to ship everything. So, I mean, think about this one thought for a second. Oil or petroleum, however you want to call it, it's used to make plastics. Nearly everything that we buy is wrapped in some sort of a plastic. The majority of stuff that we buy, it's wrapped in plastic, and that plastic takes oil to be created. For that product to get shipped from the manufacturer to the supplier to the retailer, it takes oil to move those packages around. Now, when that happens, when oil goes up, the cost of everything goes up because oil literally touches everything. I guess I shouldn't give it a everything marker, but it touches nearly everything. Everything that we do, everything that we buy, the majority of it takes oil. Just think of all the different products that have petroleum in them. So many. From baby products to female to male products, you name it. If we're buying it, it's got something to do with oil. Now, there are synthetics to petroleum. Some of our stuff that we buy is wrapped in the synthetic, not real plastic. It gets the job done, but doesn't necessarily have petroleum in it. But it does touch an awful lot of what we buy, what we do. So when oil goes up, so does everything else. And if oil is going higher, and right now I don't have a very strong conviction on the price of oil right now. I do think it's going to go up, and I think like I've said in many live streams, what's happening in Europe is a big red flag and a big what if for the price of oil. If OPEC Plus wants to continue to cut production so the price of oil goes up, who's to stop them? Who's to stop them from doing that? I know it's a negative thought to have, but it's one that I've been thinking about today. So, yes, to answer your question, everything goes up. And if everything goes up, if oil goes up, so does inflation. And if inflation goes up because oil has gone up, then is the Fed going to back off the pedal any? No, not if inflation is still going up. And Fed speak right now from all the Fed officials is very hawkish. They do not plan on letting off the gas, not for a second. So, at least for my investment thesis for 2022, the Fed's hiking and tightening to the end. I have not worked on my 2023 thesis yet. We've got a whole quarter to get through for me to write that up and put that one together. But at least for 2022, the Fed's not letting off. CPI creep up December or January is a possibility. It's a very big possibility, especially if oil continues to go up. Now, I don't know. It is possible that all the talk about oil shortages in the EU and in places in Europe this winter, maybe they're overblown, and maybe OPEC Plus isn't being greedy by cutting production, and maybe oil prices come down. I mean, they have been on a downward trend. Even the high, if we count the high right now, let me fix this chart here real quick. If we go to the June high right here, to this high is a lower high. And if it doesn't come out of this green bar before turning back down, this is a lower high still. So that is an overall weekend trend of lower highs, and I can switch that around and say lower lows as well. So another thing to point out is the fact that the 50-day moving average had turned down, but again, today it did cross that and close above it. All right, let's get off the oil topic here. It seems to be a downer. Today's stock market losses were broad-based, but somewhat modest in scope relative to the recent gains. I mean, we have the SPY down 1%. We have the Qs down 0.8%. IWM down 0.6%. So kind of holding it pretty steady there in relative terms. That 20-day moving average is holding it down right now. Now, all the major indices today, they fell between 0.6% and 1.1%, like I just pointed out when mentioning them. Trying to bring the SPY up here a little bit so we can talk about this in just a moment. But the rising price of oil, that helped to boost the S&P 500 energy sector. XLE is the ticker, up 1.8% today, which was the only sector that closed in the green. Meanwhile, utilities, XLU, down 3.3%. Real estate, XLRE, down 3.2%. Both of those fell to the bottom of the pack, just like yesterday. Interesting. All right. Let's look at the SPY, the Qs, the IWM, and then the housing market. So the SPY here, its 20-day moving average is holding it down like resistance. It did nearly reconnect with its 5-day EMA, which is a plus in my book, but we are getting a bit of a contraction looking type pattern here. It is over the upper end of its weekly expected move. And again, what it does tomorrow is going to be all based on the jobs data that comes out in the morning. If jobs data is good, maybe that gives us the momentum to pop above that 20-day. Jobs data is bad, maybe we sink back down to the weekly expected move, and the upper end is at 369. Now, going to the Qs, we'll find a similar situation. Let this chart load. The 20-day is resistance. It nearly tapped it today, just a few pennies away from touching it. and it is above that upper end of the weekly expected move, only not as much. The upper end of the weekly expected move is 277, and it closed today at 279, not that far away. Again, jobs data is going to dictate whether this breaks that 20-day moving average or sinks back into the weekly expected move tomorrow. Going to the IWM, it dropped the least today. It has a doji candle, which basically means the candle is very small and it sits right in the middle of the upper and lower wick of the candle. It did break above its 20-day moving average today, but it could not hold that and pulled back off of that. It is above the weekly moving average, which is at 171. It closed at 173. So good jobs data, and it can pop above and close above its 20-day moving average, which right now sits at 174. And again, the upper end of the weekly expected move, if the jobs data is bad, it'll sink back into at 171. Okay. Housing market. This was the best map that I could find that helped to tell the story of where in the US home prices could fall the most. Now, the darker the purple, that's where home prices, and this data comes from Moody's Analytics, okay? And the title here for this image is how much regional home prices are overvalued. The lighter the yellow, -6%. The darker the purple, it's getting into 73% overvalued, right? At the bottom here, it says, if a housing market has a negative percentage, it means home prices there are lower than expected when factoring in local incomes, because that's important. When you're talking about home prices, I didn't know whether to say housing prices or home prices. When you're talking about home prices per region, you also have to account for what the median income is for that area as well, to describe or to determine if a housing market or if a home is overvalued. Can people who live there afford to buy the homes in their own market? Darker the purple, the faster home prices went up. You can see in Arizona, it went up fast. All around Florida, it went up fast. Let's get that marker out here so I can make sure we're all on the same page here. All right. Let's see if red will do it or not. All right. So we've got Florida right here. A lot of dark purple. Okay. You see the patches of white? That's Disney. Yeah. It is. Disney is in that area. So where home prices are the darkest purple, so we've got there, we've got a little bit of Nevada right here, we've got some of Arizona in here. Prices jumped. In California, there's this one spot right here in the southern coast of California. Prices jumped pretty sharply there. Most of California, though, does fall within a darker color, especially on the coast. I'm going to carve out right here the darkest shading there. Now, this one little area right here, which is on the northwestern coast of California, that's the lightest shading there of yellow. So home prices there didn't go up as much. And again, the more home prices went up, the more they're going to come down as we go through this housing market reshuffle and home price valuation reshuffle. So when I said yesterday that I believed home prices are going to be regional this time, unlike 2008, 2009, it's because I don't think people are going to necessarily default on their loans. I think the auto industry has the bigger threat this time of auto loan being defaulted on. Okay, also in this northwestern corner up here, right, we got Washington State, we got Oregon. There's some dark patches right there too. A little bit here in the Midwest, right, like in these couple of places right there, and right here. Got some dark purple there. One little outlier right here, maybe a county or two. And then once we get to the east side of the Mississippi, we've got, let's see if I can outline. We got right here, this section right here. We got some of the Blue Ridge Mountains in there. We got the western part of North Carolina, the western tip of South Carolina, the northern part of, what do we got? Georgia, and we've got Tennessee, we've got Kentucky in here. That's a big region. Another big region, too, is a few individual places here in Texas, right there. Almost making a boot right there. Yep, people have insane car payments. They do, don't they? With how much home prices went up, with how much automobiles, new and used, went up. I mean, goodness, last year, there were several cars that you could buy used and you were paying over a new car MSRP for. It was just crazy. And then really, there's only a couple little splotches left here on the map. You can clearly see them, but there's also a lot of places in yellow. So let me use, instead of red for home pricing going down, I'm going to use green to highlight some of these areas. So we've got some areas here in Michigan where home prices could go up. We've got some here. We got Arkansas. We've got a little bit here in Louisiana, although the coast of Louisiana is a little bit hot. You got this one little triangle here in Texas and a little triangle here in New Mexico. And then, I mean, where else is yellow on this map? Maybe a little section right here. Maybe a very northern tip of New Jersey might get brought into that, which is kind of odd to think, New Jersey. Home prices are usually pretty steep here in the north east over here. But that's what I see for yellow. There is one tiny little yellow here in Alaska. I guess I should do this too to make it all fair. Hawaii, yeah, Hawaii is definitely a pricey market. So the places circled in red, those are the places, and I guess I should do this to be fair since I changed it to green. Let me erase that, okay? And now let's get back to the marker. We got green because there's a little bit of yellow right here in California. So the green places, that's where home prices could actually appreciate, go up over the next year or two. The places circled in red that are purple, that's where home prices got way out of hand, and that's where home prices will come down the most. So, did I circle a region that you were in, whether green or red. Let me know. For me, and where I'm at, it is kind of like blue right here, Northern Virginia. So we've got some orange there. We've got a little bit of, maybe this is a burgundy wineish color in my region. So what do you guys see in your region? Is it yellow? Is it red? Is it purple? Or are you in a region that is completely clear, where maybe home prices are average compared to these other places? Let me know in the comments. For real, let me know. I know you're watching. Type it in there. All right. Let me just get through this and then I'm done and we can open the floor to questions. What to watch out for tomorrow. Okay, so market participants are going to receive the following economic data tomorrow. 8:30 a.m. Eastern, September non-farm payrolls. The expectation is 250,000. The prior reading was 315,000. Non-farm private payrolls. Expectation is 275,000. The prior reading was 308,000. Well, okay. Before I move on to anything else, why are the numbers smaller this time around compared to last time around? Remember that right now we are moving into holiday season, right? All the big holidays, all the big breaks, all the big sales are about to happen. So those retail stores are hiring the part-time workers that they need to fill the positions for the holiday shopping season. That's why the numbers right now, I think, are smaller this time around this month compared to last month. All right, moving on. Average hourly earnings. The expectation is that it rose 0.3%. The prior reading was also 0.3%. Unemployment rate. The expectation is 3.7%. 3.7% is where it was last time around. And average work week. Expectation is 34.5. That's exactly what it was last time around. Then at 10 a.m. Eastern, we get the August wholesale inventories. I'd imagine they've gone up. The prior reading was 0.6%. Then in the afternoon at 3 o'clock p.m., we get the August consumer credit report. Prior reading was $23.3 billion. I am very interested in this number. If consumers are weakening, like I believe they are, then they could be using more credit. If they're using more credit, then it will show up in this report. $23.3 billion was the prior reading for consumer credit. Where's that number sit at now? I want to know. Okay. That's it. That's all my notes for today. Now, before I wrap up this live stream now, again, it's a great time to ask any questions you may have. Anything is open. The floor is yours. Still waiting to see if your home, if where you live is a certain shade here on the map. I don't think I've missed any comments yet. Okay. While you are doing that, if you could do me a huge favor, I know it's a bummer to hear YouTubers say this, but if you could click the like button and share this video with a friend, it is very, very helpful. It helps the channel a lot. And if you like the perspective and you want more, then join our private investor community by clicking the first link in the description. You'll get instant access to our weekly expected moves, our top 10 momentum stocks list, which did fabulous today. Our top 3 momentum stocks that we shared yesterday, they were up 3%, 4%, and 1.8% today. So very proud of the top 3. United Kingdom. Oh, cool. Sorry, I don't have a map of the UK. Maybe I'll look for one and share that one tomorrow and see how the UK looks compared here to the US. That's pretty cool. Thank you for sharing that. LA, surprised it's not darker. I'm surprised California is not darker too. And I'm also surprised New York is not darker as well. The thing that I'm thinking for why that could be is that during the pandemic, people were moving out of the big cities and moving into the suburbs. They were getting bigger houses so they could get a office as one of the rooms in the home. They were upgrading kitchens and bathrooms and adding screened-in porches on their back decks. They were really making it unique and their own. So, yeah, I am surprised about California. I'm also surprised about New York. New York is an orange color, which is just crazy to me to think about that. But I trust Moody's Analytics. I don't think they got it wrong. It was published in Fortune magazine, so a little credibility with both of those names. So I don't think they got it wrong, but it's definitely an interesting map. A lot of the places that I mentioned yesterday, Florida, Texas, Tennessee, some of the big ones, kind of surprised about the bottom corner of Nevada there. But that's where Las Vegas is, I believe, that bottom corner. So I guess that's why prices went up there. And then a couple little slivers that I left out here. But yeah, it's an interesting map for sure. Okay, well, if that is everything, no questions for today, then we can move on. I'll be back here tomorrow after the market has closed to talk about what happened, why it happened, and what to expect next week. Are you going to take on CPI? I haven't decided yet what I'm going to do for CPI. I haven't decided yet, to be quite honest. Let's see here. Let me go back to the SPX just real quick, and I want to mark on here. Let's see here. Let's see. Okay, let's see. One more. I'm going to put this vertical line here because, oh, there it is. The 13th. That's not what I wanted. There we go. I just put in there a URL. Okay, this horizontal line right here, the 13th of October, that's when the CPI report comes out. So we've got tomorrow, Friday, and then we have Monday, Tuesday, Wednesday. The 7th is Friday. The 10th is Monday. Tuesday, Wednesday, Thursday morning of next week. So I'd like to see what happens tomorrow. I'd really like to see what happens tomorrow. I think that will give me a better feel on next week. If jobs data is good and we pop above this, then I'm probably leaning to be a little more bullish on a potential move up for CPI. Although that is getting really close to the middle of the month, and I know historically that's not the best thing. So let's use White House secretaries. Let's put a pin in it. Let's talk about this tomorrow. I want to see what the market does tomorrow. So let's put CPI option strategy. And talk about that tomorrow, because tomorrow's market behavior, it's going to give me a little more confidence on next week. Because to be truthful, when trading a market that's got some high volatility in it, anything more than, 2, 3, maybe 4 days is kind of stretching it, of putting a probability on where the market is headed. After that third, fourth day, it gets nearly impossible to predict. Now, you can put a probability on where the trend is going, no problem. But understanding where price action is heading, that's getting a little too far out for me. So let's talk about this tomorrow and go from there. And we'll have a strategy on the CPI report tomorrow for tomorrow's live stream. AMD at 69 of a 69. Oh. I need to talk about semis real quick. SMH, which is the Van Erik Semiconductor ETF. Let's talk about this in the after hours. Boom. Semiconductor stocks got hit all in the after hours because AMD came out and pre-earnings and said, yeah, due to the PC market, things are not looking so hot. And that has hurt all kinds of semiconductor stocks. As a matter of fact, let me do this and this, and we'll come back to you in just a moment. So it probably won't show it on here, although it might. It's not 8 o'clock here in the East just yet. Yeah, this thing is down 2.1% in the after hours. So let's open this up. This is the 5-minute chart. Here we go. For ticker symbol. Oh, look at that. Okay, so 5-minute chart, right? This morning was over here with the gap down. Oh, come on. I just want my highlighter. Just give me my highlighter. That's all I want. Just want my highlighter. All right, so we had the gap down right here this morning, right? For semis. It reached its bottom down here and then took off in the morning. Right now in the after hours, this is where price action is. Under $200 now a share. So it's dropped from where it closed up here, now down to 196. 2.1% in the after hours. And some of the individual names have gotten hit even more. All right, let me clean this chart up here. I'd imagine that semiconductors, they're going to continue to fall tomorrow morning since this news came out in the after hours. Back here on the daily view of this is a downtrend for semis. The reason I'm pulling up our Twitter account, at least I thought that's what I was doing, is because I posted about it earlier. All right, come on. Come on, in load. The circle. It's taking forever. Got it. Playing both sides has never failed me. No way. I missed that. I'm shorting the life out of AMD and NVIDIA tomorrow if numbers are bad. Yeah. All right, let's see here. Come on and load. Come on and load. No, that's not about it. All right, come on. Where are we? That's the Fed speaking. That's about AMD poor Q3 guidance creates weakness among PC-related stocks. We got NVIDIA being hit, Intel being hit, Logitech being hit, HP being hit, Dell being hit, and Microsoft. They were all down in the after hours. This was 2 hours ago when I checked, when I posted this tweet right here. Advanced Micro Devices, AMD, fell in after hours trading after the semiconductor company reported preliminary Q3 results that missed estimates by a wide margin due to further weakness in the PC market. Intel is ticking lower in sympathy with AMD. Oh, and then this right here, the White House tomorrow will release new chip export rules, according to Politico. This is going to affect the semiconductor market as well tomorrow. More restrictions from the White House on what can be exported. This is more bad news on top of the AMD bad news today. So yeah, let's just go look at a couple of these tickers. Let's go with AMD since that's where it started. And just take a second to load there. Yeah, I don't you talking about shorting the life out of AMD and NVIDIA tomorrow? Yeah, it looks like it's not going to be very pretty. AMD down let's call it 4% in the after hours here. They kicked it off. Let's go look at NVIDIA, NVDA, and see how they're doing. And my long term is going to tank. Yeah, unfortunately. Let's see how NVIDIA did here. They were doing pretty bad when I last checked, but that was a couple hours ago. Down 2.8% in the after hours. So let me open this chart up here for NVIDIA. All right, it's just moving a little slow. Oh, big jump there. All right, so that green box, again, for NVIDIA, that was my buy box. It started, and we lowered this on the air during a live stream a month or so ago. 125. Oh, man, I could see it going down to 125 for sure tomorrow. It's at 127 right now. So, I mean, it is literally just hanging above. I want to get that lined up. Just getting into the red box, 125. It would be a 1.38% fall tomorrow for it to get there. With it losing 2.8% tonight, getting down to 127. Gapping down tomorrow further to tag 125, I think is a possibility. I wonder if they would, especially if this White House targets NVIDIA again, because remember, NVIDIA had this big gap down over here, 7.6% when the White House first put restrictions on what NVIDIA could sell to China. That was a big drop, and it's been declining. It's been declining ever since. I mean, it's only recently started to rebound and get some momentum behind it with the gaps up on Monday going into Tuesday. But yeah, this is going to be awful. I wonder where Intel is sitting. INTC is Intel. Wonder where they're sitting right now. I've got a few more minutes to see the after hours numbers. Sorry for keeping you guys past what I intended on, but this was important, and I totally meant to talk about this. 2.8% drop for Intel in the after hours, down to 26.42 a share. Yeah, that's just horrible. The last time NVIDIA had a big drop was on its earnings, and had a big gap down, 8.5%. Okay. Any other tickers that you guys would like me to look at? We most certainly can. Let me go back over here. Did I post anything else? Tesla upgraded to investment grade level for the first time ever. That's all about Tesla. That's mortgage rates. Okay. So let's see. Oh, Microsoft was another one that was falling. I wonder if it's recovered any or not. MSFT is Microsoft. Let that load there. Okay. If there's any other tickers you want me to look at, just let me know. Microsoft down 0.43%, so not as big of a hit. Microsoft, obviously, a bigger company and a more diversified company than AMD or NVIDIA or Intel. And Intel wants to spend a bunch of money too. I play SoFi too. It had a bounce today. We can pull up SoFi. SoFi unrelated to the semiconductor news, but that's okay. We actually did weekly expected move for SoFi this week. Let's see here. I just want to pull that list up because I didn't put it here on the chart, and I should have. But yeah, SoFi, look that, up 0.2% during regular session. And, you know, small caps like SoFi here, this is one reason why the IWM only fell 0.6% today, while the S&P fell 1%. Companies like SoFi being up 0.2%. You know, those small caps have been helping the IWM from falling. All right, where did I put SoFi? There it is. All right, so a 28%, I'm sorry, a 28 cent plus or minus potential move on SoFi. Let me put those markers on here real quick while I'm thinking about it. I see your question there. Let me just get these here right quick. And then we'll talk about your question there. I already started to form a thought. Usually every Saturday, I send out a bird's eye view of the market and expectations and things. And that goes out to our investor community on Saturdays. And the one for this week is about the upcoming earnings season and thoughts on the earnings season. Okay, so I'm putting the weekly expected moves here for SoFi. We did that and sent it out last Sunday. Every Sunday evening, we send out our weekly expected moves list, and we added a bunch of new ones this week. Actually added a whole bunch of leveraged bull and bear ETF and stocks with their weekly expected moves on them. All right, so there's SoFi, their weekly expected move. The upper end of that was at $5.16. The lower end was $4.60. This is what the options market was pricing in for SoFi for this week. We normally don't do small caps like this. We stick to bigger names. Oh, I didn't do this. Let me go back to NVIDIA real quick. NVDA. I didn't do the weekly expected moves here. Being bearish until next year, yeah. However, let me put that seasonality chart up here too, because it's always good to remind ourselves with that chart. All right, let's move this up some. These are not the updated weekly expected moves for NVIDIA, so I'm going to update. I'm going to update those right now. So NVIDIA, the upper expected move 129.54, and this is how you can do it right here. Oh, wait a second. These, okay. All right. I thought I looked at the wrong number, but I didn't. Okay. NVIDIA lower end 113.24. So there's the updated weekly expected moves for NVIDIA. So right now in the after hours, which we no longer have access to because it's now past 8 o'clock here, but it was down to 127. It closed at 131, but it was down to 127. So whatever happens in morning trading, that'll affect NVIDIA here. So 127 does put it within that weekly expected move, which it seemed like it was headed for that anyways. The upper end 129.54, the lower end 113.24. Okay, let's go back over here and let's throw this one up and let's talk about this for a moment. Okay, so how does the market react to an overall bad, maybe horrible earnings season? We kind of had some bad earnings the last two earnings season, but very mixed. The past, let me just say this. So far in 2022, the earnings seasons that we have gone through have been good overall. Overall, they've been positive. In the next quarter or two, or maybe even three, which would put us at the halfway point of 2023, they are shaping up to not be so good. So far, we have seen this past quarter, well, last quarter now, July, August, September, which is Q3, which is about to be launched in about a week and a half or so. We should start to see cracks in earnings this coming earnings season for Q3 earnings. And the reason I say that is because over the past 3 months, we have seen companies come out and do revisions on their earnings, and they have lowered them. You can actually track revisions, earnings revisions for each company. And you can get a scorecard on how they typically do. Are they typically, do they typically raise when they revise their earnings? Do they typically raise them or lower them? And they have a scorecard for that, because the more accurate a company is at predicting their next earnings, the better that company performs. If they're way off, overestimate, underestimate, that dramatically affects their stock price. So just look at the handful of companies, bigger name companies, that have come out and have pre-released portions of their earnings report for this upcoming Q3 earnings season, which is, again, week and a half away. It starts with the financial sector, the banks report. If the earnings are poor, what happens when a company comes out and they do two things on their earnings day? When they come out and they miss on earnings, they miss on EPS, they miss on revenue, that can negatively impact their stock. The second thing they do is they project what their next quarter EPS and revenue, sometimes margin, what is it going to be like? And that future projection also heavily impacts their stock price. So if companies come out and say, let's say they meet earnings expectations, they're slightly off, just a little bit either way, but basically they're flat. The market won't like that so much, because the market over the past couple of years has grown accustomed to companies downright beating their earnings. Yes, there are exceptions. Look at Netflix. Look at Zillow. There are many out there, especially some small caps. They've just been hammered this year. But the big boys and the big girls have been holding up pretty well. All right, so they're mixed on earnings. They're basically flat, and that's EPS and revenue. But then the second part of their earnings is their projection. And what if they project that Q4, we're not going to be able to meet our prior projections for the next quarter? Or better yet, since it is the fourth quarter that they will be projecting, they will also be projecting what they think they'll do for the overall year of 2022 or fiscal year 22, however they set it up. And they say that we're not going to quite be able to make those projections. We're going to be a little bit under. Their stock's going down. And the more that they are going to miss on that projection, the more that stock is going to go down. So when we have an earnings season, like you're asking, when there are possibly horrible numbers, the market will go down. And it'll go down drastically because the market is forward looking and the market will have to reprice in where that company's earnings will be in the future. Second here, we kind of had some bad earnings the last two earnings season, but very mixed. I think over the next 2 to 3 quarters, there will be a growing list of companies that are not hitting the marks that they projected they would. This quarter, we're going to have more than last quarter. Fourth quarter, we're going to have more than Q3. First quarter of next year, we're going to have some pretty awful numbers compared to the fourth quarter. And then Q2 of next year, I'm not really sure about. I think they're going to be even worse. I think we have another 3 to 4 quarters, which is another year of a not so good economy. Now, I know at the very beginning of this live stream, I said I do not have a thesis for 2023 yet, and I do not. But I do have thoughts and ideas. I just haven't put them into a thesis yet. So, I'm pretty sure you're pretty smart about the answer to your own question. The market, when you look at the S&P, 500 companies. If half of those companies miss their earnings, that's going to do significant damage to the S&P 500. And again, that's why I have right on here that box. All right, I just went too high. All right. Oh, I'm on the SPY. That's why the box isn't there. Anyway, it's down around 320 on the SPY, and it's about 3275 on the SPX. I think that's where we could see a 2022 bottom. I don't know that that would be a bottom for this bull market, because if we're in a secular bull market, then we're just going to continue to make lower highs and lower lows for 6 months, 12 months. Who knows how long that could be? I mean, this could end up being a lost decade. It's definitely going to be a more, what would the right word be? I don't know. A more cautious decade where people are not spending as much and they're saving more. I think the pandemic could have taught people that that's what you have to do to prepare for the next one, whenever that may be. Okay, let's see here. What else? I see your question there. You're still new, never seen an overall bad earnings season. All right, this is perfect. And I don't want to miss your post here about being Definitely bearish until the end of the year, next year, and beyond. I'm with you, definitely. We're going to have a rough go at it, for sure. And let me pull this one up here. I'm still new, never seen an overall bad earnings season. There are so many investors out there right now who are in the exact same boat you are. Haven't really seen, you're new to the market, haven't seen a bear market before, haven't experienced a bear market before. You can hear people talk about bear markets, but that's something you've never seen. Let me go here to a monthly chart for the SPY. I gotta click a button, make this look a little better. And then we're gonna zoom out and get a better feed on this. You hear me say this all the time. Over the past 14 years, investors have become so reliant on the Fed. And the Fed stepping in at every little moment to prop up the stock market, pump money into the market, quantitative easing. That has been the slogan for the past 14 years. That's over. This bear market, and I don't want to sound doom and gloom, but we're just getting started with this bear market. I don't know if you guys realize or not, but last week in the United Kingdom, they had a crisis. They had something break. And they had to rescue their bond market by buying billions of dollars of bonds on the open market. The UK central bank had to step in to avert a crisis. But that was pretty big. Pension funds were on the verge of failing in the UK just last week. What happens when that comes to the US? What happens when that comes to the reserve currency of the world? This could be a bigger crisis than 2008, 2009. We could be headed for a bigger crisis than even the dot-com bubble. Or what about the 1920s, 1930s Great Depression? If you look at this stock market, you can see where the Fed stepped in. You can see it clear as day. Look at these candles. From 2008 to 2022, look at how much money was pumped into the market. Look at how parabolic from the low in 2020, and I'll open this up a little bit. Right now, the stock chart's not going back past 1994, but it gives you a pretty clear indication here. All right, let me just, okay, pause right there. Here was the COVID low, right? And then the market from that low went like this. Look at how straight that is. If I were to grab this trend line over here, right? And I'm going to take it from down there up here so I can match this slope, all right? Now, Let me make this a little more wider so it's clear. I'm going to take this. I'm going to take this trend line, okay? This slope from the COVID low through 2022. All right, right here. We can match this slope for a little bit. Going from, where would this be? This would be December 2018 up to April 2019. We can match that slope. All right, let's see. Where else can we match that slope? Maybe a little bit right here in June of 2016, maybe for a month or two. Where else can we match this slope? Once I start bringing this trend line over here, it starts to, like, you start thinking, how in the world did the stock market go up at that angle? Quantitative easing, that's how. Look at even these bottoms over here. Even the 2009 bottom doesn't even slope up like what we just went through from 2020 until January 2022. Nowhere does that slope match. Nowhere. Except, again, maybe that 2019, oh, right here, maybe a little bit right here, just above my head. This will be the September 1998 bottom, going to November 1988. We had that slope. Nowhere else. Everywhere else I place this trend line, it looks like an absolute joke. It looks like an absolute joke. Look at that. This trend line matches. Look, I mean, it's like going, you can't go any more vertical than that on the stock chart. March 2020 through January 2022, the stock market had unlimited QE, quantitative easing, where the central banks printed and poured money into the markets. It's a meme stock. Absolutely. You nailed it. Not to miss over your cannabis stocks question there. I see it. I don't want to miss it. But while I'm on this topic, it's a meme stock right there. There's no other way to put it. With the Fed pumping that much money into the market, it's only a matter of time before the same amount of money is pumped out of the market. That's why back in January and February, I was laughing about 2019 theory, that prices are going to pull back to their 2019 highs. And for a lot of companies, that's already happened. That's already happened. Look, if we go here, right before the pandemic, I got a December of 2019, the S&P 500 was at 32. I'm sorry. The SPY, let's get here. December of 2019, the SPY closed here at 321. 321. So when I say that I can see the market falling to 32.75 in 2022, it's not far off. It's not far off. The SPY falling to 320. It's at 373 right now. The SPY coming down to 320. It's not a joke. It's a reality. This is just incredible. The slope of this, it just blows my mind every time I do this. It's incredible. Okay, I went on a rant there. My apologies for doing that. Didn't mean to. All right, so let's do this. Thoughts on cannabis stocks. I'll be honest with you. I'm not an expert on cannabis stocks. That is definitely true. But I do believe I can pull up a list of them. See, with cannabis stocks, what it's going to depend on, in the news yesterday, I think it was, or in the news today, I can't remember where I saw it. President Biden is going to pardon, I believe, anyone who was federally convicted of having marijuana, a tiny level, and he's going to pardon them all from federal prison. President Biden is also looking to change the how marijuana is listed, right? A class 3, a class 1, whatever the case may be. Illegal substance, the classification of marijuana. Joe Biden wants to change that to make it so it's not as, I don't know what the right word is because I don't know the classifications for these different, but maybe somewhere where a prescription narcotic is, I don't know, because I don't know the codes for them. However, if that's accomplished, that would be a boost for cannabis stocks. If any country, if any state within a country, I'm thinking United States here, or a province in Canada, or if they legalize marijuana, the more that do it, the more valuable the retail shops become, the more valuable the cannabis stocks will become. So right now, it's like the very early innings of a baseball game when it comes to cannabis stocks. And there's still a lot of things that need to happen for cannabis stocks to be recognized and have more inflows, not just from retail traders, but from institutions, pension funds, and so forth. Right now, cannabis stocks, they're not at that level. Like, to give you an example, electric vehicles. 5 years ago, they were not very popular. Since 2020, they've become very popular. And over the 2020 to 2021 rally in the market, I mean, you're looking at this big stick just sticking up there. A lot of money was pumped into electric vehicle stocks. However, it was a little bit too early to actually do that. Some of them, look at Rivian. It became a publicly traded company. It raised lots of money, and then it has fallen. Its stock price, its valuation, mainly because we're entering a bear market. We're in a bear market. until cannabis is legal in more states, and I'm thinking here in the United States, cannabis isn't even on the level of electric vehicles 5 years ago. So I think that if you believe that cannabis is something that could and can be legalized state by state by state, or even on the federal level in the United States, then it's just a matter of time before the cannabis stocks will start to gain traction, will start to gain inflows, and the price appreciation will go up. But until that happens, these small retail cannabis shops are fighting with the cartels, and they cannot win against the cartel. The cartel ships it across the border, ships it into every city. They have distribution, they have transportation, they have the whole network, and it's been up and running for years, decades. The legal pot shops that are out there today, that's what they're fighting with. And until states legalize it, at some point we'll reach this point where, and I'm thinking futuristic here when it comes to cannabis stocks and the retail cannabis store. At some point, say it's when, 20, 25 states have legalized it, maybe it's even legal on a national level. The cartels aren't just going to give up all that money. So I think at some point, if we reach that equilibrium where it's this 50-50 of it's legal in half the states in the United States, it's legal on a national level, what's going to stop the cartels then from opening up the retail shops? Maybe they don't go public with their companies. So there's and I'm just saying this to lay out that there are a lot of roadblocks that cannabis stocks, they need to go through still. Any fluctuation in price action right now is just speculation. That's what I believe. That's what I think. And it's all these different roadblocks that I just laid out. The two biggest ones is making it legal and then, winning the cartels. That's when cannabis stocks, I think, actually start to become valuable after it gets past those roadblocks. But until then, it's just speculation. Okay. Anything else you guys would like to talk about tonight? We've had some great questions and conversations here. I can't believe it. It's been wonderful. So I'll give you a minute or so here. If you have any other questions, plug them in. If not, please do me that favor and click the like button and share this video with a friend. That helps out this channel a lot. I know it's annoying to hear, and I don't know. The YouTube algorithm, it should be friendlier. And if it was, I wouldn't ask, but that helps. Leaving a comment on the video helps tremendously too. Not just on the live chat, but after the video uploads and going back and leaving a comment there. I mean, those simple things, they help to support this channel. Okay. All set for tomorrow. All right. We are good then. So I'll wrap this live stream up, and thank you guys so much for spending your time with me. I greatly appreciate each and every one of you. And I'll be back here tomorrow after the market has closed to talk about what happened, why it happened, and what to expect next week. You are absolutely welcome. I'm here for you whenever you are. I'm ready. I'm ready when you're ready. All right. Thank you guys so very much, and I'll see you in the next video. Take care.